Hello, welcome back to the channel. So in today's video, I'll be talking about cheap stocks and whether or not they are worthy of a buy, as well as how to value a stock. So we'll go into the companies first, and the first stock that I would like to cover is Lululemon. So Lululemon year to date is down around 50%. It is currently trading at a 12 times of earnings. So for Lululemon, it operates in your athleisure market. It is an extremely saturated market, and as you can see, there are many different competitors in this space. And for Lululemon, they hold around 21% of the market share in this space. Overall, this space is a terrible industry to invest in because there's a lot of competition, and competition is generally for losers. But despite this intense competition, Lululemon is clearly better than its competitors. So over here, this data point actually shows the customer retention of Lululemon as compared to its competitor, which is Alo. So this is customer retention over the next 1 year after the first purchase. And as you can see here, Lululemon's retention rate is actually at a 36%, which is more than double of Alo's customer retention. So this clearly signals that Lululemon provides more of a premium product, provides a higher quality product, and despite the higher pricing, customers are still coming back to Lululemon. So for Lululemon, they have two levels to pull right now. They have the pricing as well as the store count. So they've been increasing their store count massively over the past few years on an average of around 10%. And overall, this is a reliable stream of revenue growth for the company. As for the other portion, the pricing portion, Lululemon has been quite aggressive with pricing as well. So in 2022 and 2023, they jerked up their pricing by quite a fair bit. And we're seeing pushback from customers now. And as you can see here, these are some of the comments that were made regarding Lululemon's price increases. Over here it says, I bought a water bottle a month ago at $39. Now it's $49. That feels like an overkill to me. Huge turn off. So Lululemon has been exercising extreme pricing power, but as your nominal value increases, it gets increasingly hard for Lululemon to increase the prices at the same rate as what it has historically done. So for this company, the story is as such. So currently now, 75% of the revenue actually comes from the United States, as well as in Canada. So majority of their revenue actually still comes from those portions. As for the remaining 25%, it is from other places around the world. So you have China, you have Hong Kong, you have Asia as well. All these markets are growing rapidly for Lululemon, and it's a segment that is spurring growth for this company. So for this company, the main story would be around the China growth. So China actually makes up 50% of that 25% international revenue for Lululemon. And as you can see here, the athleisure market in China is projected to grow at around 10.9% over the next few years, which is a major growth segment for Lululemon. The company has said that this market could be a $33 billion market for Lululemon, which is quite massive in the grand scheme of things. So for this company, if you have to compare its China growth as compared to competitors, so for example, you have Nike, Anta, Li-Ning, Lululemon is the company with the greatest growth here. So this clearly shows that they're doing something right in China. And in a bull case scenario, if they can continually grow this segment at 20% over the next 5 years, the China revenue could make up around 20% of the total revenue, making the international portion around 40% of the entire revenue chunk for Lululemon. So besides that, the company is also priced for no growth. So if you were to look at the EV to EBITDA, Lululemon is currently at around 7 times EV to EBITDA. So it is extremely undervalued relative to its peers. So for example, you have Deckers here at around a 10 times, you have Nike here at a 23 times. So overall, Lululemon is clearly a stock that has been suppressed in terms of valuation because of its slowing growth. And while it is not entirely unjustified, this valuation discrepancy over here between Nike as well as Lululemon is something to pay attention to. So for this company, I think it is priced for almost no growth. The upside here on out is probably greater than the downside risk. Of course, the downside risk will be that your comparable sales in the US continues to decline. But overall, the story is decent for Lululemon. The valuation is sound as well. If you're looking for a short-term company to invest in, then I think Lululemon at its current valuation today is a decent company to look at. The next company that I'll be covering is Adobe. So Adobe is down around 20% year to date, currently trading at a 22 times of earnings. So for Adobe, if you have to look at the subscription number, 2025, which is this year, is actually the first year that they've experienced some sort of decline in terms of the subscription numbers. This is worrying for Adobe. So Adobe has been under attack. The stock price has been under attack over the past 2 years. As soon as ChatGPT came out, as soon as you had Gen AI images, And for Adobe, this is worrying as well. This clearly shows that the company's moat is weakening. So if you're to compare Adobe as compared to Veo3, as you can see here, these are some of the features for Adobe as well as Veo3. Adobe is lagging behind its competitors. So if you're to compare CapEx as well, Adobe is not spending a lot of CapEx. They're not spending anything on this Gen AI portion. What they're doing is they're trying to integrate competitors into its own platform, which could be good in the short term. I mean, these competitors are still small. But once they scale up, they don't need the Adobe distribution platform anymore. So for example, I'm sure Google doesn't need the distribution platform of Adobe. So if Adobe doesn't build out their own AI model, then this could be a headwind for the company in the future, especially if competitors are able to come up with better models. So for example, Veo3 over here is clearly a lot better than Adobe, and Google currently holds the largest share in your AI video generation market as compared to Adobe at around 29%. So Adobe is lagging behind, the company is cheap, but the story is weakening. So for Adobe, the bottom line is as such. The company is cheap, the stock is cheap, but it is cheap for a reason. The company is fundamentally weakening in its competitive positioning. And while the stock is fundamentally great, it's probably an avoid now given its loss of market share. The subscription decreasing value is actually a metric that you should pay attention to. It clearly signals that the company is having a lot more churn because of your Gen AI portion. So the longer you hold this company, the more risk you will have to take. So for me, I think Adobe is a company to avoid, even though the company is trading at a cheap valuation, unless it drops to an unreasonably low price. The next stock that I'll be covering as well is in China. This stock is one that is talked about a lot, but many investors don't like this company. This company is Pinduoduo. So Pinduoduo is trading at a 14 times of earnings, currently up around 35% year to date. So for this company, their positioning is as such. They have their own niche market in China. So in China, you have three different companies. You have JD, which is Jiangtu. You have Pinduoduo, as well as Alibaba. So Alibaba targets the higher tier one. It is the legacy online retail platform in China. JD is more of the logistical portion. So they have a logistical monopoly in China. The logistical portion is why the company is still strong today. As for Pinduoduo, they target more of the lower tier cities, which make up around 70% of the entire e-commerce platform portion in China. So for Pinduoduo, they have artificially suppressed earnings, that is the thesis for the company. So if you're to look at this R&D portion, the company is spending a lot of money on R&D because they're trying to build out all these logistical networks, they're trying to build out all these warehouses, they're trying to build out a platform and create an ecosystem that's great for both sellers as well as buyers. So this is similar to what we saw with Amazon in 2022. In 2022, what Amazon did was they built out a lot of different fulfillment centers. They spent a lot of money in that portion. They spent CapEx, they built in R&D as well. And that artificially suppressed their earnings in 2022. And that was why we saw negative earnings in 2022 at one point as well. And currently now, we're seeing something similar with Pinduoduo. They're trying to build out all these fulfillment centers so that in the future, they reap the benefits of it. So that is why we saw net income dropping in the last earnings quarter. The net income actually went down by 4%. The operating income went down by 14%. And while I don't expect this trend to continue here on out, and this could be a number to pay attention to and a thesis that could possibly play out. So for Pinduoduo, this is what is really interesting. So for Lulu, he actually bought around 17% of his US portfolio in Pinduoduo, which was quite interesting. It was a one-time purchase, meaning to say he bought everything in one block. Lulu is a great investor. He wouldn't have bought into this company if he didn't see something. If he didn't speak to the management, if the company isn't high quality, he probably wouldn't invest into it. So this really piques my interest over here. So for Pinduoduo, this company is operating in a very competitive space, but in the medium term, this company could work out with a clear catalyst coming up as well. So the Chinese consumer is actually recovering right now. So that could be a tailwind for all these online retailers. We're seeing that with Alibaba as well. They got 10% revenue growth in their online retail portion. So Pinduoduo could experience something similar as well. Besides that, profits could start growing again once the R&D slows, once we see increased operational efficiency and reaping the benefits of all this R&D spend over the past few quarters. So they're sort of just delaying their earnings. They're suppressing their earnings right now so that in the future, they can get long-term sustained growth in terms of its earnings. So I don't disagree with what the management is doing, and that's why this is an interesting company to look at. And besides that, there's another company in China as well. It is JD. So this company is actually decent as well. It is trading at a 9 times of earnings. Valuation wise, this company is incredible. It's the cheapest out of the three companies, of the three online giants. And this could be an interesting company to look at as well if you're betting on a Chinese consumer recovery. Of course, the story isn't as good as Pinduoduo because this company is a lot larger, the growth is probably slower. But this could be one that's interesting to look at if you're betting on a Chinese consumer recovery. Next portion, I'll be covering my EPS as well as my DCF calculation. So this comment over here actually said, "Hi Guan, can you talk about DCF calculation and EPS growth calculation model?" So I'll cover the EPS portion first, which is the easier one. Then I'll go into the DCF portion. Let's talk about the EPS portion first. So this is sort of like an EPS model that you can take a look at. This is a simplified version. This is the easier method of the two. DCF is actually a very long way to value a company. Whereas for EPS, this is actually a very simple model that you can try and build on your Excel spreadsheet or your Google Sheet. So let's take a look at some metrics that you need to input in here. So there's the growth, you need to input your growth assumption. There's the current EPS. You have to input a P ratio as well. So what you can do in terms of your P ratio is to look at the historical value of the company, is to do your comps, so compare it to other companies in the same industry. And this is actually for Visa, so I put around a 29 times price to earnings for Visa. And then of course you can input the dividend as well. And as you can see over here, the CAGR for Visa is around 10.6%. So what that means is the company is pricing in around 10.6% in terms of share price returns over the next 5 years. So normally fair value is around 10%. So if you're looking for stocks that are undervalued, you should aim for a CAGR of above 10%. And currently Visa, I would say, is around fair value. As for the other valuation method, I'll be covering this one as well. It's your DCF model. So this is an entire model that I built out for Amazon. So for a DCF model, it is a lot more complicated. You have many different portions to this. So basically, you have the different financial statements. You have your cash flow statement, you have your balance sheet, you have your income statement. To build all of them out. You have your revenues as well. This is a revenue schedule built based on its different revenue segments. So for example, Amazon has online retail, they have physical stores, they have their third-party sellers as well. You have to build all of this out. And then after that, you have to build out all the different schedules as well. So for example, over here, I built out the working capital schedule, I built out the income statement schedule, as well as the depreciation schedule. So as you can see over here, Amazon's depreciation is about to accelerate. It's going to increase all the way to around 19% of its entire revenue in a few years' time. So that's a number to pay attention to. If the company doesn't accelerate its revenue, then this could be a problem in the future because the depreciation could eat into its bottom line. And then after that, what you can do is to build out a free cash flow model, something like this. So this is a free cash flow model that I built out for Amazon. And as you can see over here, the fair value for the company is currently around $200 a share. So this is a full DCF model. So this is what you have to do if you're trying to evaluate based on your DCF model. But for simplicity, I think the simplest method is simply just to stick to this EPS model. It is a lot less complicated. It is a lot easier. And it gives you an indication of the fair value of the company in just seconds. Last portion, I'll be covering some questions left in the comments. So the first one, it says, "Thanks for the video again. I want to invest in Google, but I believe it's way too expensive now. What price do you think it's a good time to add again?" So I think for Google, the company is probably slightly overvalued right now. I trimmed my initial position at around $230 a share. I trimmed around 15% of my stake. So for Google today, I wouldn't add at anywhere near today's price. I think Google at around $200 a share is around fair value. So if you're looking to add, you should probably add below that $200 a share. I'm bullish on this company, especially with the cloud growth and especially with the extension of their different products and their different suite of products under the Google search portion. So for Google today, while the stock is overvalued, I'm still bullish on the company. If you're looking to add, I think below $200 a share is probably a reasonable price for you to add into this quality business. Next comment, it says, "What do you think about Ackman's top picks like Uber, Brookfield, Amazon, and so on?" So all these different companies here have done pretty well for him. I mean, Uber is up probably around 40% since he initially started his position. Brookfield is a juggernaut as well. It's been up by quite a fair bit. But for Brookfield, I don't understand the business. It's an asset manager business model similar to Constellation Software. They acquire a lot of different companies. And overall, I tend to stay away from all these businesses because it operates on high leverage. So Brookfield is probably an avoid for me. As for Amazon, it's a company that I'm bullish on. For Uber, it's a decent company, but I didn't like the valuation at any point of time. And the robo-taxi story is definitely a risk that could play out in the future. So for all these companies here, Uber as well as Brookfield, I think it's an avoid. As for Amazon, I think the valuation today is decent. The fair value, as we mentioned earlier, is around $200 a share. So if you're looking to add into this company and hold it for the long term, I think this company is a decent one for you to look at. I hope you guys have found this one useful and invest. See you.